Okay, good morning to everybody who's just joined us. Nice to see you here, bright and breezy. We will just wait a few minutes and then we'll get cracking about 2 to 3 minutes from now.
If you need to share the slides.
Yes, I was just going to ask.
Okay. Good morning, good morning, good morning. Nice to see so many people here.
Morning, Mark.
How you doing, Daniel?
Very well, thank you. Yourself?
Very good indeed, very good indeed. Nice to see you.
And yourself?
Where do we find you this morning?
Just in the office. Just outside of Chester, North Wales.
Oh, what's the lovely part of the world?
Yeah, lovely, yeah.
Good stuff. Good stuff. Okay. All right. We'll wait 1 more minute and then we'll get started. We have lots of people signing in with code names. Could just rename yourselves so you're not FG473XQ. Wherever you are.
You never know, they might be children from Elon Musk and that's their legitimate name, so.
True. True enough. I never got over Prince changing his name to symbol or squiggle or whatever he was, but you could be right. Scary days, scary days. Okay, it's 8:30 in Budapest and Madrid and 7:30 in the UK. So a very warm welcome to everybody on this autumn morning. Lovely to see you all. We'll just kick off with in a second, just with a little bit of housekeeping. But first of all, I say welcome to today's session. We're going to be talking about credit risk assessment through the lens of AI and the Moody's organization. So for those of you who don't know, I'm Mark Harrison, and I'm really thrilled to welcome our good friend Afia van Kreyen from Moody's.
Good morning.
Okay, if you just pop us onto the next slide, please.
Yes.
Thank you. So just so a little bit of housekeeping. We're going to be recording this session for CPD accreditation. CPD is continuing professional development, so you'll all receive a certificate in the not too distant future, showing that you've invested 1 hour of your time today in being part of this session. The recording will be available afterwards, but only for Callisto Grand members, so please get in touch about becoming a member with us. And the key thing of all the credit clinics and coffee clubs that we run is they're interactive. So it's not myself and Afia kind of rattling on for the next hour or so. We really want to hear from you guys, right? So that can be through the chat as a written discussion, or preferably put your hands up and you can actually join the conversation, right? So the form is that Afia will set the scene. She will go through a few slides for 15 minutes or so, and then it's an open forum for us all to discuss and kick around what we've seen. So just to kind of lead into Afia, I was kind of doing some research on this, and what we're going to talk about today really emphasizes that credit risk is much more than just numbers, and credit or order to cash is much more than a back office transactional process. It never should have been, but in recent times, the last sort of 20, 30 years, it's kind of gone down that road. But really, as we'll see again today, it's a skilled profession, and we're all in this risk business protecting our most important and our most precious asset, trade receivables. Just to give an example of the risk business, in the UK in 2023, there were 26,595 companies went out of business. In France, it was more than double that, so about 57,000 companies. Now, there'll be all different shapes and sizes, all different industries and so on, but a phenomenal amount of companies. If you think in France, that's more than 1,000 companies every week going out of business, right? How many of those companies could have been predicted? How many of those situations could have been predicted or even avoided using the latest technology, right? And when we think about the size and scale of what we're talking about in terms of bad debts and so on, this is a huge subject. So I'm going to pass over now to Afia to explain what Moody's are doing, and the floor is yours, ma'am.
That sounded very depressing to kickstart the morning.
Yeah,
but
yes,
okay.
yes, and have a good day, everybody. Yeah, yeah.
Good morning, all. All right. Good morning, everyone. Just 1 second about myself. My name is Afia van Kraan. I work as an industry practice lead for Moody's. Industry practice lead specifically focusing on trade credit, covering the entire of Europe. Essentially, I lead, let's say, the product strategy, product development on the Moody side, specifically for trade credit. So I do a bunch of roadshows and events to, first of all, share the good words that we hopefully have about this, but also to take, let's say, the feedback from the markets, to feedback from the business, to see what are the needs, what are the impacts that we see, and basically how do we alter solutions to make sure that we are ready, not just for what's going to happen next week, but ready for the next couple of years. I'm dialing in today from Madrid. I'm looking at the pool as we speak, so I'll try to be not too distracted this morning. I really hope this to be an interactive session, so please use the chat. If you don't like to speak up, just put it in the chat. By all means, speak up. As Mark said, I've only prepared a couple of slides, so it's really the idea that we have this kind of discussion. And anything where you have remarks, where you don't agree with me, or anything that you would like to share, an anecdote, etc., just feel very free to pitch in. Before I go into my first slide, Esther, we have a couple of questions, very easy yes or no questions prepared. If we can put up the first question, that would be lovely. And I have no idea where or how it's going to appear, so this is quite exciting to see. But we should, oh, there we go. Perfect.
We go.
Works?
Yeah.
Yes.
Do we use AI in our personal lives?
Perfect.
It's interesting. 30% of people say they don't.
Okay, I'll just give it a couple more seconds, and in the meantime, I'll just talk us through things. So for the by now 30-ish% of the people that say that you don't use it, the truth is everyone has been using it, maybe without us knowing it, because AI has obviously been around for a very, very long time. It could be something as simple, for example, as going on a website and basically the computer recognizes that it's been used, so they kind of give you like a pre-fill thing, or maybe, and I find that super annoying, if you type on your phone, they give you like suggestions on what you could write in your text messages. All of these forms are a form of AI, so it doesn't necessarily have to be the "Hey Mercedes, call my father," or "Hey Siri, switch on or off the lights." No, that's not Siri, that's Alexa. Sorry. So it basically has been around for a very long time. Esther, if we can switch to the second question. Oh, sorry, share results. Do I need to click on share results? There we go. So we had
yes.
a 70-30 approximately, which who said that they were using it or at least actively using it. If we can go to the second question, please.
Absolutely.
Thank you.
Visible?
Yeah. So then the second question is basically on a business level, let's say. So in your professional life, are you using it there? Okay, we're it's a 60-40. Oh, we're almost going into 50-50. No, 60-40. Right, I'll give it 5 more seconds then. All right. Do you guys see the results or do I need to click on share?
I will share it. I just need to
Okay.
end the poll.
Okay, perfect.
Now you should see the results.
Okay, so people then say that approximately 60% is using it for business. I think a little bit the same thing. I don't know if, for example, now within my emails, I already get suggestions. If you are on LinkedIn and you get an in-mail, then people will get this notification that says like, okay, hey, sounds good. So they're basically already making suggestions on what you could reply to an email. So again, it happens more than you think. And we will see in a number of slides that there are different types of AI. If we can go to the third question, Esther. So you see, it's no difficult questions, right? So it's so then we talk about Gen AI, and I think it's important there that we make the distinction because people now think when AI is mentioned, everyone mixes it up. The difference obviously with AI and Gen AI is the generative part of it. So it's basically that we create something new. Whereas with AI, we're basically just, let's say, facilitating. We are automating certain tasks. Whereas within Gen AI, we're really going to create something new based upon what was learned in the past. This is very interesting. So currently, the majority of you guys are not using it in your personal life. If I may make a couple of suggestions, because I was also a bit skeptical a couple of years ago with, for example, the ChatGPTs, but it's actually really awesome for how you can use it. It's basically could be your personal trainer. If you go on holiday somewhere, instead of buying 5 books, you can basically say, hey, I'm going to do a 4-day trip to Budapest next year when you're going to the conference and you want to extend your weekend and stay for a couple of days longer. You can basically say like, I'm going there, take me the top 20 of tourist visitings and make it like in a very intelligent way. So you don't go through one end of the city and then all the way to the other end of the city. So essentially, it can really help you as a bit of a travel guide. It can, if you have only a couple of ingredients in the fridge, make me like a nice little meal, etc. It's insane what you can do with it. So I'm a huge fan by now. But still 60% of you is not using it. So I invite you to check it out because it can really make your life easier. And then the final question, you will have guessed it, that will be, do you use Gen AI for business? And I'm keen to see if, and this could be all kinds of business. So we're not just talking about within your credit risk assessments. It's more overall, are you using it in any kind of way in your professional life? And interesting, we're going again into the 40-60. And David is sharing something in the... Yeah, David, that's a very good point. So if people are looking into the chat, David just send us, I don't know if it's a meme or like a funny thing. But that's a big thing that we will cover. Essentially, the rules with ChatGPT should be that if you're not comfortable putting it on your LinkedIn or on your Facebook profile or whatever, you shouldn't type it in a ChatGPT. Because literally all the information that would go into a ChatGPT is essentially then being shared with everyone. Could be, first of all, wrong information, but secondly, of course, sensitive and confidential information or personal information. You should obviously avoid that. I fully agree to that. So the Gen AI for business, I see approximately 40% is using it, 60% is not using it. So I think that's a very interesting group to kick off this session with. And it's okay, Esther, you can stop sharing. Thank you. And by all means, I'm a huge fan of these things that David shared. So if you have more of those, or if anyone else has more of those, love to look at that. Sorry, Esther, you were saying.
No, I was just saying the floor is yours, all yours.
Okay, perfect. Okay, so because it's still oh, it's called a cartoon now. Sorry. All right, let me go into our next slides. Just to set a bit of the landscape there, are a bunch of things on the slide, but it's more to set the landscape of Gen AI in overall. So on the one hand, if you're looking at the bottom of the slide, we have the companies like the OpenAIs, the Meta AI, etc. Those are the ones, for example, that are indeed providing the likes for ChatGPT, etc., which is open to everyone. And as David very well noticed, is indeed that we need to be very careful with that, because on the one hand, we don't have any control of what's happening with the data. And it has access to basically everything on the internet. So we don't have any view on the sources it's using, whether it's wrong, right, etc. And a lot of these models are basically producing what we call hallucinations. AI are people pleasers. They will want to give you a reply. They will never tell you, sorry, I don't know. They will just spit something out regardless of the quality. So this is indeed something that we need to be very careful with. In the middle of the slides, we see that we have the technology providers, the infrastructure providers. So we're talking about the Microsoft, the Google. The list is quite extensive. They are the ones that are really giving an infrastructure to the large language models. So for example, the OpenAIs, the ChatGPTs are large language models. They're providing an infrastructure. I don't know if some of you are working with Copilot. We are now within the company working with Copilot. The good thing there is that the information is let's say secured. It's a closed environment. So for example, Copilot has access to all of our tools, but all the information that goes in there strictly remains within our own respective Copilots, which is a huge difference, of course, like with the ChatGPT. Also, the sources that we are using are limited, so it's not that we can access whichever website on the internet. This is just a day-to-day thing that we are using to make life easier. And we see that many companies are adopting it, that they have those partnerships with Microsoft, for example, to also integrate their Copilots. It's really about facilitating your life. It's not that it's replacing what you should be doing, but it's more of the task where you would put a lot of effort in, like drafting an email on a certain thing. It's just like take all these topics, or if you have internal calls, instead of taking notes all the time, it's basically listening in, and it's creating you a summary in a matter of seconds, just to make life easier. What is Moody's doing in that perspective? We're basically training models. So we'll see later on some of the examples that we can use within let's say, credit risk assessment. Again, we don't want to have a model hallucinating and giving you whichever answer that they can come up with. It's really about training the model, almost like you would be training a credit analyst, a credit manager, credit director, etc. And it's also getting them familiar with specific data related, in this case, to credit. We also do that in other I'd say in other areas, for example, compliance, but basically to make sure that it's almost like you're talking to an analyst and not just I was going to say Angela. I named my ChatGPT Angela. So if Angela is making hallucinations, etc. If we take, for example, I took a random name of something that we typically a bank or a company that we really don't know. Say that we ask ChatGPT to provide any warning signals. This is now a certain bank. The answer that we would be getting from ChatGPT is essentially like, okay, we looked at 2022 financials. There are no explicit warning signals. Everything suggests basically that it's a healthy financial status for the bank in this case, in that period of time. If we then, for example, look at the reply that we get if we ask it to a dedicated, let's say to a dedicated system, then we see, for example, this is coming out of our Copilot. We notice that there is a severe risk because we look at more recent information. We noticed that an implied rating, there is a high credit risk. At the same time, we're also looking into news information, and we saw that the bank had been penalized with a fine of 250,000 euros. Which inevitably is a reputational risk and could potentially lead to more compliance-related issues, which is already giving a different view than what we saw within the ChatGPT. And then we also see that the bank is basically controlled by a corporate entity, which has an implied rating, which is pretty okay, which kind of mitigates the all-over risk. So you can see that the answer is a lot more nuanced than it was if we just look at the sources that are out there, and also if we train the model to know where to look for. So for example, also taking into account the ownership information, taking into account more sources than just looking at financials. So for example, in this case, the news as well. So it's all about being able to use verified sources, and again, also knowing that the person obviously is not a person, the avatar, or whatever you want to call it, that it's essentially someone who is trained to look at certain type of information and to provide a dedicated answer. If we look in that perspective, specifically for credit risk assessments on, let's say, the different types of information that we should be looking at. So on the one hand, what you saw with the ChatGPT, it's basically looking at some company data. Essentially, that was about the financial information. What we now try to do with the Gen AI is that we really try to match, if you want, as many sources of information as we can. And obviously, you would see that it's almost impossible with credit teams. And this is at least a trend that we see, that the credit teams are reducing in size. Yet at the same time, the number of reviews that need to be done are increasing. And it's not just about maybe 10 years ago where we would basically be looking at a credit report, because, and if you were in some of my presentations in the past, we see how fast things are changing, and that we need to look at more than just, let's say, what we could consider the obvious financial risk. If we look at the situation of today, we're 2 weeks away from the US elections. I do need to tell you that regardless of the outcome, it's obviously going to have a big impact. I think this year alone, 50% of the world population had to vote at some point, where we see lots of shifts, whether to more the left or the right, etc., which will also have, again, an impact on the way that we are dealing with certain countries, which will have an impact, again, on certain sectors. So it's really more looking about more than just a financial risk. I see that there are some things in the chat, so I can't multitask. So if you give me a second, ESG is indeed a major part of credit risk. Be good to see the weightings on how much these 6 elements influence decisions. Very good point. ESG, why is that so interesting at the moment? Well, first of all, because banks are taking this into account. There is a correlation between the ESG performance of a company and basically their cost of capital. So those companies that are scoring low on the ESG side will have a higher cost of capital. And I think, and this is what we try to uncover, it's a bit the domino effect, the snowball effect, that if every type of risk is slightly elevated, what is basically the trigger point that a company would have a serious impact on their creditworthiness? What do I mean by that? Imagine a company is performing not at their best. At the same time, they have a low performance on ESG. They may have buildings that are quite old, and we know that with the Paris Climate Agreement, we need to be carbon neutral by, is it 2040, 2050? I think 2040. So you know that they will have a high transition risk as well. What is a transition risk? It's basically the cost that you will have to transition into whether renewable energy or energy efficient buildings, etc. So if they need to apply for a loan with a bank, we know that they will have higher interest rates because they have a low ESG performance. So are they able to make all those costs? So it's really trying to find that, let's say, that balance. Sorry, I'm just going at the chat.
Can I just?
Yes, please.
I'll keep an eye on the chat. Feed you the interesting questions. On the subject of ESG, and I think this is one of the critical things we're going to take from today. You know, as we're moving away from purely just numbers and so on. An example of ESG, because ESG stands for environment,
social governance.
Social and governments, yeah. Environment being like where a building or a company is located. And a very practical example of that is in the last month being here in Budapest, and walking down the Danube, where there's all the restaurants and hotels, you know, floating restaurants and so on. They were completely, the whole lot were completely wiped out, right? From, you know, all the traditional things you see in front of the Parliament, the castle, you couldn't get to them. The access bridges from the path, well, the pathway was under 3 meters of water, right? So this is where, from a risk perspective, I think, you know, these are the things that need to be taken into account now, like physically, where is the place located? Yeah.
100%, and a number of things that we are doing there, not just on the customer side, but you can imagine also on the supplier side. It's really understanding that if you're maybe like a production facility, the company itself, or as you mentioned, like smaller businesses such as the restaurants, etc., or hotels, if you have that kind of damage, even if you are insured, the time that you are, first of all, waiting for your insurance to pay out. Secondly, indeed, the damages, etc., that you have. And especially because we see that the weather events are becoming more and more extreme, and also coming into regions that we typically wouldn't think of. Like when we think about climate risk, we usually think about typhoons and hurricanes, etc. But I think the last probably 5 years, the number of floods that we have seen. So I'm from Belgium. We had in the summer of 2021, we had this huge floods in Germany, the Netherlands, and Belgium. I think Eastern Europe was heavily affected indeed a couple of weeks ago. So it's something that we need to be more and more taken into account. And it's also understanding, especially the let's say the links between, again, everything. You can be at a high climate risk or a high physical climate risk, for example, but it's really the add-on effect of everything. Same thing with the transition cost. So many companies are still located in very old buildings, and again, they will have a huge cost transforming those entities or those buildings into, for example, energy efficient. But you're absolutely right, Mark. I think climate risk is one of the biggest risks that we see in the future. On the ESG bit as well, obviously there is all the things about the sustainability, etc. So yeah, again, that's all things that we need to take into account. And I see that Brad is effectively saying that there is no global standard. That's correct. Oh, now there is a lot of, Mark, if you can read through what is being put in the text.
I'm making notes, and I think we'll go through the slides because there's a load of things to come back on. Right. So
Sure.
at ESG, I think is going to be one of the big ones. I was just jotting down a few points there, particularly about this standard. So I think we'll come back to that because it's going to be a biggie.
Yeah, perfect. Okay. Also happy to do a follow-up session at some point on those types of risks. But really the point that we are trying to make is there are so many things that we now need to take into account along with economic scenarios. Obviously, the economy is not performing at their best. At the same time, a lot of the information that we have is what we could consider a bit of outdated information. So it's really to go out there and find sources where we can find almost real-time information. And then again, the Gen AI piece can really help us with that. Esther, I think there was a poll question that we wanted to raise as well. I don't know whether it's going to appear on the or in the chat or, oh yeah, there we have it. So essentially what we want to understand is basically what are the risks that, I'd say basically that you're currently dealing with where, for example, Gen AI could help with. So feel free to just say, I think we can easily say it. It's climate risk, it's cyber risk, it's supply chain disruptions, it's news, or it's the links between customers where we are potentially overexposing ourselves. So if we don't catch the links between companies, how that would, let's say how that would impact. Okay, so Brad is the first one. It's about catching news, which is definitely an important one. So other people can just weather type, it's supply chains, it's cyber, etc. So you can just use the short and we'll come back to that as well. Essentially what we try to say is that, especially with the Gen AI, we try to step away from the what is happening to why something is happening. Again, because we have all these kinds of interconnected risks that we discussed in the past. So if we look at a company that perhaps will have a lower score, that we need to understand why that is happening, because again, it could be, it could also be, let's say, generating an opportunity. What do I mean by that is imagine you have a company which is scoring low because of various reasons. It's really deep diving into the why. It's going into conversations with those customers and really understand what is going on, because it doesn't necessarily mean that you shouldn't be doing business with them or should lower their limits. Potentially you can partner up with them and work on a mutual plan. Obviously, you can't do that for all your companies, but the idea is really that you, using Gen AI, that you can automate a significant part of your reviews, essentially liberating time to focus on the customers where you should be speaking to. If we look into AI, just as before we go into some of the final slides, we basically see 4 levels of sophistication. We first of all have the assisted intelligence, which is basically retrieving information or running something for you. That could be an analysis, a tool. But that's literally also, for example, asking Siri to basically make a phone call. So it's just basically giving you some assistance, making it a bit easier for you. If we move into the augmented intelligence, we basically want to amplify. So it's really helping you. It's helping you spot things that maybe you wouldn't have spotted. I think a good example is, if you're aware about this, the IBM Watson Health. So basically helping doctors, if they look at scans, to detect the slightest changes, etc., that the human eye couldn't possibly detect. So it can basically augment the intelligence of a doctor, if you want to call it like that. The same thing with looking at, for example, your reviews. Maybe there are things that you wouldn't have spotted because you wouldn't see the link between it. This is where AI can help you detect certain links, like, for example, okay, you're looking at this company, maybe you didn't see that they have a low ESG performance. This is what the impact could potentially be. At the same time, they have a high climate, physical risk, etc. So it's really spotting those trends that we wouldn't be able to spot. Brad made and David made a comment about not catching relevant news. One of the things that we are doing, for example, with the Gen AI, and it's also machine learning, is basically using about 25,000 news sources, and they're scanning around the clock over 1 million of news articles, press releases, the investor reports of companies, to basically find relevant news, which potentially could impact the creditworthiness of a company. Again, that is not the absolute truth. It's more detecting something which could potentially lead to having a serious impact on the creditworthiness of a company. We would then have also what we call the automated intelligence. And I think there, the automation, it's really that the focus is on doing tasks independently. Also, let's say, using recommendations or making recommendations. Essentially, okay, this is what we have spotted. It's not just saying it, but based upon what we have spotted, this is basically the recommendation. So imagine you have an exposure of whatever, 100,000 on a customer, that the AI would basically tell you, okay, we've done the review based upon the recommendation. Instead of the 100,000, you can basically, let's say, increase it to 150,000, or based upon what we've seen, it's better to decrease it to 50,000. So they can already do those recommendations. And then basically the final piece, what we then have, is really the autonomous intelligence. Examples in real life are probably the Amazon warehouses, your Roomba that kind of trains itself to go into your house and find their own paths and adapt if they, bump into a chair. It's also the Teslas, the self-driving cars, but the autonomous within credit, for example, where we could see is that basically this is your portfolio, these are your review dates, and that basically the AI can say, well, okay, by the 15th of November, these reviews need to happen, that they can actually do it by that time, that they can also evaluate the outcome and, for example, also adapt. So again, if we say that limit would go into 50,000, that they can basically make those changes. Again, there is always the possibility, of course, to basically interact, and it's not about replacing, right? There we go. Sorry, I was trying to read the chat at the same time. Sorry.
I was making some
multitask, right?
I was making I was making some observations to the group. So I think the biggest takeaway I'm going to take from today, as we were talking, when we were prepping up, 4 different types of AI or 4 interpretations. So I think when we hear that phrase, we need to ask the question, so what exactly do you mean by AI? Is it, one of the 4 you described, or are people actually really talking about IA, intelligent automation, or is it maybe even further back upstream, like machine learning, for example? So I think we really need to challenge what these phrases are before we just say, yeah, it's AI, and drill into what is its application, like you've been describing there on the previous slide.
Yeah, and I think it's important to take that into account, given it's also people's, let's say, level of comfort, right? A lot of people, given AI, especially the Gen AI, is a fairly new thing. I think it's important that we educate people indeed on what it means, that they also know they're already using it up to a certain point. But if indeed, and we would see that, I think, in many companies, the whole autonomous thing you don't feel comfortable with, to be very honest, I'm not stepping into one of those self-driving Teslas, at least for now. But there are things like, if you hear the application, it's not related to credit, but still the IBM Watson Health, it absolutely makes sense that a doctor would use AI to basically detect maybe early signs of lung cancer, breast cancer, whatsoever. And I think within credit, it's the same thing. It's not that they should make the autonomous decision, but it's really, okay, you don't have an infinite amount of time. And there are so many sources that you need to check and understand the links. So it's really helping you there. It's the augmented piece, at least. The autonomous piece, etc., that's probably more in a later stage when everyone gets more familiar with it. But I think it's very important that we understand the different nuances there are. Going back to my slides, this is a little cartoony. This is one of the things that we try to do, or that in an ideal world we would have. Imagine that you are the one wearing the crown. You are basically the supervisor, regardless of your level of management, etc., within the company. Within your credit risk assessment, you are your supervisor. In an ideal world, what you would have is basically a group of experts. Could be the industry expert, the macroeconomist, the microeconomist, cyber risk, etc. All those little agents that are an expert within their respective fields. And obviously as well a validator, because information that your little agents would bring up to you, they need to be validated, they need to be verified. And there's also the little red team that can basically say, okay, the information that we got there, we want to challenge it. We need to find additional sources to basically, let's say, validate again the results. So imagine, and we now go into that autonomous way of working. If we want at some point to automate our credit risk assessments, taking into account all or most of the information that we could find, this is then a bit of the simulation of how it would look like. So it's a 1 minute video, which is a real-time analysis that we would do. So in this case, we want to sign a big deal with a retailer to basically manage their online system. And we want to carry out a credit risk analysis on that company to basically understand business drivers and impact on future performance. So you basically type it in. There is an orchestrator, which is essentially the one who is guiding the entire analysis that needs to happen. So we've started a credit risk workflow. We look into a knowledge-based management agent to retrieve the report on the company, who is then passing it on. Again, it's autonomous, so they can pass it on to their friend, which is a credit analyst. The credit analyst is going to retrieve the right model, whereas the credit analyst agent is retrieving the weights from, this is a tool from Moody's, but that can be any type of tool. The credit analyst is currently analyzing the report for assessment. It has done their analysis, which is passing it on to the orchestrator. They're doing some quality assurance, so the information is updated timely. It is faithful information. We verified the sources. It's complete information, so we have all the elements that we need. And now the quality assurance agent is passing it on again to the agent's orchestrator, who is basically the one running the analysis. This is then the information that we come up with. This is the business overview. This is the financial performance analysis based upon a number of items, so which is then liquidity, the solvency, the profitability, as well as the efficiency. We found information on the risk drivers, mitigation of the risk, and the key financial ratios, which are essentially impacting the risk the most, along with information on external environment and essentially the competitive landscape. So we look at the market conditions, we look at the competitive position of this company, any regulatory environments that can alter it, any other types of risks, such as the cybersecurity, the economic conditions, and any operating costs. And then we come up with the credit risk conclusion as well as the summary. So this is a real-time example of how these little agents all work together to basically provide you with an overall analysis, which took us about 1 minute and I think 17 seconds. So this is where we kind of see the future of just doing a credit risk assessment. We're not even talking about, you know, automating your processes internally. I know there are a bunch of tools as well in terms of collection, etc. But it's really just about the credit risk management piece. What do we mean by it? If you have a portfolio of maybe 10,000 customers and you can run those analyses at the same time, this is the output that you would be getting. Obviously, you will read through the report that we're currently looking at. And then it's basically up to you, right, to take a decision. At some point, you can move into maybe even the autonomous piece. But essentially, it's all about liberating time. Yes, you could go and find all these pieces of information together, but it's really making sure that you get that you win time. And then once you are looking through all of this, you may notice there are a couple of risks. This will give you time to, for example, reach out to your customer and understand, okay, we've noticed this type of risk. Are you mitigating this in any way? Which could again alter then the outcome of the analysis. So it's really all about liberating time. It's making sure that, and this is where the human steps in, that you essentially can again, have the time to basically go and speak to your customers, understand what how they're mitigating risk, what the potential opportunities would be. But again, that you don't, between brackets, waste a lot of time on doing the research, but basically getting the outputs, being able to interpret it. And then for the customers where you need to, where maybe it's a bit of a gray area, where you can essentially just have conversations and partner up with them to make sure that you how to say it, that you can work together to find a solution. Does this have the ability to drill down into its findings? This is a little video, but yes, you could have indeed the access to Brad. You can indeed have access to the underlying information. I think that's again key. It's about consolidating the information. And the good thing is as well, it's like an agent, right? So you can also ask it questions like, can you please, for example, we see effective management of ratios. Can you basically go more into details, for example, on that one?
And I think perhaps a supplementary question to that is that one of the things we talk a lot about in Callisto, through our training and just in discussions and so on, is that information in credit collections, O2C, etc., is real time. You know, and I think we often overlook, you know, information that's coming through cash allocation teams. Are companies paying all their invoices? Are they missing few? Are they paying later? Are there more disputes? Likewise, short payments, deductions, and so on. Likewise with collections, you know, when they're talking to people, they're picking up valuable information, or they should be, which is the advantage of using the telephone rather than the email. You know, so they should be picking up valuable information, and then those what should we say, those sort of pointers, you know, the indicators, they could then be applied to this, you know. So my customers I just found out my customers laid off 50 people, right? And you could kind of augment this with a real-time situation, and that could be built into this, yeah, and you could get a feedback. That's kind of this?
Yeah, no,
Yeah.
absolutely. And this is now what we do basically on a customer by customer. But the next step that we're working on is basically say, now do this on a portfolio level, where it's not just about, and again, this is probably more going into the third and the fourth bracket of the AI bit or the Gen AI bit. It's also essentially saying, well, if I want to take more risk on this customer, what do I need to do with my overall portfolio to not increase the overall risk on the portfolio? So it's also making those suggestions, and that they will go out and find like, okay, on this customer, this is the risk that you took. However, these and these and these things could indicate that you know, they're on a very good path. So you can take more, you can grant them more credit, more limits, for example. So I think it's all about that, right? It's again, it's helping you. Well, I see there's a big text from
Yes,
Daniel.
I'm just going to try to read through that. Yes. Yeah.
Yes. Yeah, no, all good, all good. It's just that again, I don't multitask anymore. But no, 100%, no, but it's a very fair point, and I think that's all about it. I know, Mark, you always make the joke that the credit department used to be the sales blocking department, but I think it's 100% that
It reverse.
we see a lot of cases where especially credit departments are now partnering up with their sales teams, because it's not about just, you know, finding the risk, it's also about spotting the opportunities. And it's indeed the fact that you don't want to wait until you do another review or until you get a question from sales that you need to review, for example, a limit or a new request. But it's really about, you can automate a big chunk already of it and then basically work maybe on still a big part of customers or potential customers. And that is where the overall growth of a company could be, essentially, right? So I think it's a very fair point. It's all about being able to move a lot quicker, and indeed, obviously, to take more accurate decisions, because you take into account, well, as much information as you can, but in a very efficient way.
Yes,
Brad?
the point is there about the human element, that we have all this information, but we still need people to interpret it. Absolutely right,
100%.
and that is the fact, because there are always going to be circumstances that no machine at this point is going to pick up, discussions that are taking place, long-term strategies, and so on. And I think with all these great observations that are coming through, great comments that are being made, I think the one thing that's really screaming out here, and it's something that we campaign about all the time in Callisto, is the credit department cannot stand alone. Right? It is absolutely an integral part of every aspect of order to cash collections, disputes, cash allocation, and so on. And I say this because so many companies still to this day don't include credit limits on their aging reports, and things like that. And it's still seen as some kind of mysterious analytical department that is not connected to, you know, like I said, collections, cash app, and so on. And everything is absolutely fundamentally connected. It is not. So anybody that has in their organization that credit is reporting to a different department, you must absolutely campaign that it becomes one. As we say, in the old days, we used to call it credit control, because we controlled credit right from cradle to grave. Sorry, Afion, carry on.
No, by all means. And I think, and I'm a huge advocate to change. I know we always talk about order to cash, but we hear it more and more that it's the lead to cash. Like, you should already be in the phase where if a sales department is working on a couple of potential deals, instead of waiting for them to say, well, hey, this is the one, please review it. Please make sure that you're already a step ahead, like even up to the point where you work together with people from marketing. You have all the knowledge about the existing customers. You know what is basically your dream customer, as in which business are they in, what is the typical behavior of that customer. You can basically work together with marketing and say, well, these are the companies that we want to target on.
Yeah.
Instead of sending out a mass mailing to whatever X thousands or X hundred of companies, these are the ones that we've already pre-screened, that we know that, okay, we're happy to work with them, we are able to grant them a limit, instead of saying, well, we're just going to reach out to whichever company and we'll see in the end, after we do the analysis, whether or not we will grant them a limit and have a discussion with sales, and so on and so on. So I think it's a big thing, not just with sales. I think also with compliance. Doesn't make any sense that you do credit reviews if compliance is going to say no, because maybe those entities are sanctioned, etc., and maybe not sanctioned just as such, but if you look at the aggregated ownership. So it's really about making sure that all information within a company is shared, right? Brad,
Well, the whole working capital cycle. I mean, the credit risk starts with the suppliers. And that's so vulnerable now more than ever before too, isn't it? So that's where we as a credit team, as in everything, the whole O2C, etc. As you said, we can actually improve sales. We can target the good companies, and also we can reduce strain on the supply chain through looking at our suppliers, which it's all connected. You know, the whole thing is, if you can't make stuff, you can't sell stuff, right? So
no, 100%. And also that even if you wouldn't see the dream customer popping up, at least if you feel confident about the other ones, you can still move into a discussion along with your sales folks to go and visit the customer or potential customer and say, well, okay, we would be happy to do business with you, because, and I know, Mark, in the preparation of this call, we had that example of that construction company. Just to set the scene for other people, there was a construction company which had basically all signals going from orange to red. And it's one thing that you can then say, you know what, we're not going to give you any limits anymore. Probably that company will go bust. What we can also do is basically sit together with those companies and say, well, okay, we've noticed something is going on. Please tell us. And you could actually help them in a way that's, well, first of all, you can say like, we do a bit of a payment plan, or, you know, we get, I'm not going to say weekly meetings with them, but at least they keep you posted on certain things. Whereas if you simply say, we don't give you a limit anymore, they can't get any goods, they can't produce, or they can't sell, or they can't deliver their projects anymore, hence they will not be able to pay anyone and they will inevitably go bust. So I think it's also there a bit of a really sitting together with potential customers or with customers. And I think this is also where your growth could be. And I think those customers in the end will probably be your most, let's say, loyal customers that you can have.
It alters the dynamic of the relationship when you actually go to a customer or supplier and say, hey, we know, or it appears that this situation is occurring. That I think that really does change the dynamic. It doesn't say, wow, they're actually checking on us, or they know stuff about us. So it moves those important conversations much further upstream, so they start at an earlier stage, or part of this prevention.
Yeah, 100%. And I think especially when we show this video, half of the audience is impressed and the other half of the audience is annoyed because they feel like, oh, is this going to make my job redundant in the end? That's not the idea. I think going back into the 1750s with the Industrial Revolution, yes, factories have become more automated, etc. But that's not because then we lost all of a sudden the people. We still need the people. It's just about making life easier, spotting things that we wouldn't be able to spot, but it's liberating again the time to have those discussions, to see growth for companies. And up to Brad's point, it's really helping the teams make better informed decisions. But again, you can never take that human factor out, and the human gut feeling and the human interaction that you would have with a customer, where again, you can spot whether or not you could partner up with them. Valentina. Yes,
Likes the
yes,
AA
agree to
model.
that. Yeah.
She's
Yeah.
in the impress zone, as opposed to the others that are skeptical. Asking a question and coming on to sort of the practical aspects of this from the point of view of Moody's. What are the drivers that companies are coming to you now and saying, we need to improve our visibility over our customers, over our suppliers? What are the main catalysts that are making that conversation happen?
Well, I think most of the things that it's a bit of everything at the moment, right? It's the geopolitical bits. We talked about, well, I briefly mentioned the US elections, but obviously with the situation in the Middle East, etc. It's again, we're not going to wait until something happens. If the conflict with Iran would be, evolving even further, and maybe at some point we'll see huge impacts on the oil price, etc., etc. We don't want to wait until that happens. We like to do a scenario analysis now, and our customers imagine this or this or this goes up, or we're heading into winter. God knows what will happen with gas prices, etc. It's about being as predictable as possible. It's not waiting for something to happen, then catch it and say, well, we caught it in time. No, it's about what is going to happen in the next couple of months, even up to the level that we now want to make up different scenarios. How is this going to impact our portfolio? It's about the geopolitical bit. It's about, as you mentioned, the climate risk, right? It's getting like with hurricane, what was his name? Milton. And the other one before, we see categories 5, etc. What is going to be the impacts? There are solutions now that you can simply say, we want to do an analysis on our portfolio of customers. If we spread them geographically, what do we expect in terms of extreme weather events? Obviously, that's based upon the historical trends, but also on the forecasts that we have with the, the water level that are rising, etc. Okay, if that happens, how are our customers affected? Then you reach out to your customers to understand, are you aware of these risks? Are you mitigating this risk, etc.? So every question that we now get is really about how can we be prepared, not just for next week, but basically for the next 6 months, the next 12 months, the next 18 months. If we say that something like climate risk and cyber risk are going to be 2 of the most critical factors in the future, then companies want to know how they can prepare today. You don't need to wait until 2 years to then say, oh, we should have, improved or recalibrated our models. It's something that people want to work on today. And if
the
you
knock on
just,
sorry, carry on.
No, I was just going to say, like, if you look into every possible news bit, like you mentioned, there are so many companies going bust now. Lots of companies had a lot of government support following COVID, but now we see that, that kind of grace period is running off, and in combination with the let's say deteriorating economy, etc., the increased prices, consumer behavior, which is also obviously changing. We talked about ESG. ESG is a big thing, whereas companies could be, to say it in a modern term, almost be cancelled if their consumer base is all of a sudden changing, changing their minds because some things happen in the news that they don't feel like buying into this company anymore. So it's because there's so much going on that, again, people want to be as predictive as possible, and that's the main reason why currently they're reaching out to us.
And many of our attendees here, by the way, which is another record number. So thank you very much, everybody. We peaked around about 90 through this morning. So thank you very much. And the majority of people here are working in shared service centers, so multinational shared service centers. And one of the whole objectives of working in this environment is that you can collate all this information. So you don't just look at the clients, the customers in isolation. You look at them across all. I don't know if you're responsible for 15 or 20 countries. You look at them together holistically, and this is the advantage of what you've been showing us this morning. Is the analytics can be done in no time at all. Like you said, a minute and 17 to run that video, which can be a whole kind of profile on one or more companies. Even though they're trading in 10 different countries, you bring them all together, right? And that's the point of shared services. And this is why business service leaders are saying about where shared services can bring more value to the business. All the things that Afia has been describing today, you don't look at it just in isolation. You look at it across the whole piece, and maybe even globally. You extend beyond your area of responsibility. It's incredibly exciting to be working.
But that's also a bit the thing. Like, we typically see you have your shared service centers typically indeed in the area of Eastern Europe. You have then another one in the APAC area and in the Americas. And still in a lot of cases, although it's global shared service centers, they will have their own remit in terms of the region. And there is so much information which isn't shared. And then if you have those conversations like, why is this information not shared with the other service centers? It's most of the cases because it's a matter of lacking the time. And I think there is so much that then could be done to really work as a global company. So yeah, sorry, that could be like another.
No, it is, because so many
2-hour session, right?
So many organizations are calling themselves GBS, Global Business Services, and this is the prime kind of a prime example of what that really means. Global means global. It doesn't just mean EMEA or the Americas or ASPAC, like you said. Global means global. And with the data, you said you had how many million companies at your fingertips in Moody's?
It's 535 million at the moment.
See, that's pretty substantial, right? We got 5 minutes left, but another question that came as a running alongside this. This must also kind of change the relationship with credit insurers too, right? Because now the genie's out the bottle. There's no excuse that information cannot be found. If a company does go bust and so on, and it's credit insured, I guess credit insurers are also buying into these kind of facilities that you're offering, changing the limits that they're giving. And also, if you are insured and you still carry on and your customer goes bump or gets into trouble, that's also going to change the dynamic in that arena as well.
Yeah, 100%. And it's funny because I'm at one of the biggest insurance events at the moment. So they're all there, not just credit insurance, but also any type of insurance. And so the dynamic that we see is, on the one hand, people have these type of new insurances, like related to cyber risk, physical risk, etc. On the other hand, what we see with the credit insurers is that we tend to, let's say, partner up a bit more with them, whereas maybe 10 years ago, whether you had a credit insurance or your own analysis, it's now more of that combination of things. Like, yes, we have 535 million companies, but let's be very honest, your small independent, God knows what, in South Africa, we will not have a lot of information on that simply because the information is not there, and they will also not appear in the news because they've done something. So I think in some regions, definitely it makes sense that we then partner up and say, well, okay, this is everything we've got. Maybe they have information because of other claims and this and that. We don't have access to that for obvious reasons. But it's really like, okay, can we partner up and let's say make sure that we can provide the joint company that we work for, if you want, or that we work with, that we can give them like the most complete information. This is the information that we have. This is what credit insurance can do for you. Let's make that best combination and not just say bluntly, we're going to fully insure, we're going to fully do the information ourselves, the analysis ourselves. It's really finding that, let's say, golden solution in between. It's all about partnering up.
The blend, yeah. It's and I think that, and I was thinking of your other products, your parent-child database that you have, the Orbis, or the rest of it. It's all when you bring everything in together, it's a very powerful proposition. Plus the information that the operational people are seeing on a day-to-day basis. So it's as I mentioned earlier. Sorry, go on.
No, I was just going to say, like, it's no longer about looking at a company report or even looking at the hierarchy of companies. I think I mentioned the example. It's also about zooming out. One of the things that we're now working on is more of a fraud detection type of thing. So it's not really even about creditworthiness, but it's more of a, is this actually a legitimate company? One of the things that we now have is the shell company indicator. So it's basically zooming out. A company on paper can do very well. But if you then zoom out, we, for example, see that on the same address, you have 5,000 other companies. We have that street in the Philippines, 500 meters long. There are, is it 30,000 or 50,000 companies registered there? Then you know there's something fishy. However, if you look into a single company, everything can look smooth. It just chose an exotic location, which in itself is already a bit of a flag, but all right, you get the point. Or directors that have 170 companies on their name. Could be that they're very, that they're very busy, or it's just that we know that they're just constantly establishing things. So it's really, again, there is the power of the big data, and this is where the large language models can help us with. It's detecting those links, and I think ownership is a big one. Yeah, absolutely. Sorry, I see that we're almost at the time. I know you have a slide left, so.
I was going to say, I think we, as you said, we could do 2 hours on this. This has been the most incredible 60 minutes, and I'm sure everybody feels the same. So if we can just nip onto the last slide, please. I think we'll definitely have to have a follow-up on this in the not too distant future. All right. So Afia, thank you so much again for being here today. I know you got a lot going on at the minute, so bless you for preparing and doing this. To everybody who's joined us, thanks so much, Esther, for organising it behind the scenes tirelessly as always. Thank you. And as you can see on the screen here, we got upcoming events as well. November the 6th and 20th, we're going to be online with more credit clinics. We're going to be doing another conference, a one-day conference in London in March, and we're in Budapest. So get these dates in your diary already, please. Credit Matters. So get these dates in your diary, please. If you're not already, follow Callisto Grand on LinkedIn, and also please get in touch directly with Afia or through us if you want to talk to Afia and Moody's. If you can't get in directly, please contact us and we'll put you in touch straight away. Okay, so time is up. Really, everybody, thank you so much. It's been a wonderful hour. We'll be in touch. I'm sure we'll do this again in the next couple of months. We'll follow up on it. Yes, it's such a big subject. In the meantime, take care, stay safe, God bless, and carpe diem. See you all very soon. Take care. Bye-bye.
See you.
Just want to hang